Hello everyone, my name is 𝗪𝘆𝘀, Assistant Manager from iFAST Research Team. After a challenging performance last year, the Japanese yen experienced another sharp sell-off against major currencies in 2023. Nevertheless, we believe that 2024 will mark a pivotal moment for the Japanese yen. Despite multiple interventions last year, the Japanese yen weakness persisted as the Fed hiked rates, prompting authorities to issue repeated verbal warnings against selling the currency. Even if direct FX intervention is not implemented, this signaling effect would prove to be helpful in alleviating depreciation pressure. The speculative short exposure on the Japanese yen remains large. The warnings create an incentive for traders to cover their short positions on the Japanese yen as the risk-reward turns less favorable. Besides that, the yield curve control (YCC) is becoming unsustainable. Major companies agreed to average pay hikes of 3.58% this year, marking the highest increase in 3 decades. For the spring 2024 negotiations, Japan's largest labor organization, RENGO, plans to request a total pay hike of over 5%. As wage growth strengthens in 2024, Japan is more likely to be getting out of its 25-year battle with deflation, the very reason why the YCC was initially implemented. BOJ Governor also acknowledged for the first time that the probability of achieving the long-term inflation target is rising gradually, signaled a gradual move towards the YCC. This suggests the possibility of additional policy tweaks during future policy meetings in 2024 to pave way for the potential abandonment of the YCC. As many other central banks have opted to halt interest rate increases, we expect yield differentials to narrow, resulting in an appreciation of the Japanese yen. Our optimism for strong yen outperformance is also underpinned by the fact that valuations, as gauged by the Japan Real Effective Exchange Rate, are at an all-time low since data inception in 1970. In summary, we believe yen bulls eagerly waiting for a turnaround will not be left disappointed again in 2024. This time is likely to be different. What will truly be a game changer is the narrowing of yield differentials driven by additional policy tweaks and a potential shift in response to a new era of sustained inflation while other central banks pause or end their rate hikes. We believe that an appreciation in the yen would enhance the attractiveness of Japanese equities to foreign investors, and we also hold the view that the investment case for Japan is well supported by corporate governance reforms and Japan's resurgence as a semiconductor powerhouse. We remain optimistic on the outlook of Japanese equities and prefer an unhedged share class to maintain exposure to the Japanese yen. Investors may consider the Eastspring Investments Japan Dynamic Fund (SGD Unhedged) or the iShares MSCI Japan ETF. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Jason will share more about 𝗀 Oilfield Services. Over to you, Jason.
Hi everyone, this is Jason from Global Fixed Income team. To introduce 𝗀 Oilfield Services is the oilfield service company providing drilling technology and equipment to upstream and midstream oil companies in different markets. For example, China, Iran, and Southeast Asia. Under the high oil price environment or when the oil producers have the strong cash flow, they will gradually increase their capital expenditure to expand their production capacity. So that the oilfield service companies will thus benefit. The oilfield services cycle usually lag behind the whole oil cycle by about 1 to 2 years. So the oilfield services company are the indirect beneficiary from the high oil price environment. So for 𝗀 Oilfield Services, their operating performance is quite decent. In the first 3 quarters of this year, the company's new orders increased by 22% year over year to around 4.3 billion RMB. The order backlog also increased to around 10 billion, which is historical high level from the company perspective. On a side note, under the current high oil price environment, the counterparty risk of the company should be low because the company's clients are the medium and large oil companies. So actually the counterparty risk is quite low. On the other hand, regarding the highlights on the credit matrix, which is the decreasing trend of the net gearing ratio. So their net gearing ratio decreased from 58% in 2020 to 17% in June 2023. So the net debt to free cash flow is also another highlight, which is also low at only 1.0 times. So we conservatively estimate that the company could generate at least 800 million RMB, which is equivalent to $80 million US dollar free cash flow from the second half of 2023 to the end of 2024 within 1.5 years. To conclude, along with the end-home cash risk position, large increase in the order backlogs as well as a strong free cash flow as mentioned, the company has a strong repayment ability to repay the 2025 bond. So under the high oil price environment, the bond yields of almost all oil producers with strong solvency has significantly declined. So the end-home oilfield services bond is probably the only choices for the investors to find a super high yield investment with a manageable credit risk in this oil and gas sector. So the bond of end-home has a yield to maturity of over 20%, which is quite attractive. So to get the full analysis, you can scan the QR code or click the link below in the description part. That's summarized for the sharing of this week. Catch us again in the next week for more investment ideas and updates. Thank you.